Welcome to Fall into ETF Investing, a special edition of ETF Market Insights. I'm Erin, VP of Online Distribution at BMO ETFs, and in just a moment, I'm going to be turning over my hosting duties to Adrian Starinieri. Before I do, a quick reminder that during today's episode, we're not providing any advice or investment recommendations. Today's show is all about education around investing and around using ETFs for Canadian do-it-yourself investors. Adrian Starinieri has been using income-oriented strategies in his own investment journey for some time now. He's also the creator of the Passive Income Investing YouTube channel, where he talks a lot about his income-oriented approach to investing. Adrian's also part of the FIRE movement and retired early and is now living in Panama, which is why he's going to be joining us virtually. So now, Adrian, I'm going to turn it over to you.
All right, so there's no question that for aging clients, retirees, they're on the hunt for income solutions and stable monthly income, some younger demographics as well, like myself. So inflation, of course, is dominating the headlines. They're at very high levels globally, all eating into the purchasing power of our money. So this is a key variable on a lot of investors' minds today. So today, we will cover how covered call strategies are an effective way to enhance income in your portfolio. So we will look at their construction and the important considerations you as an investor must be looking at when evaluating a solution. So I'm very happy to be joined by Chris Heakes, Director, Portfolio Manager at BMO ETFs and Lead PM on BMO's covered call strategies, and Andres Rincon, Director and Head of ETF Sales and Strategy at TD Securities. So Andres has an extensive background in equity derivatives or options. So I'm really looking forward to our discussion today. So let's start off with you, Chris. So many of the covered call solutions, which we will get into more during this session, use a dividend portfolio as the base of the portfolio, which is the most traditional form of income investing, right? Dividends. And then they write call options on that portfolio or the stocks inside that portfolio. So can you quickly take us through why dividends are, first of all, a good base, and BMO's unique screening approach and methodology behind your dividend ETFs?
For sure. Thanks, Adrian, and great to be back with you again. I think when you think about cover call strategies, the immediate traction is that yield, the 6 to 8%, that can help tackle the challenges like inflation you just mentioned. But, one of the most important things is actually where does it start from and what is your underlying equity portfolio? At BMO, we try to construct, multiple different kinds of exposures that investors can build a really strong foundation on. But one of the ways you can do that is with dividends. And dividends offer investors to really benefit from stable and mature companies. Now, I would say, to your point on what's the BMO methodology, not all dividend companies are made the same. Often when a dividend company has that 8% yield, that can sometimes be a sign of increased risk, a possible dividend cut on the horizon. But starting with high quality dividend payers, companies that have been increasing their dividends, companies that have a sustainable dividend policy. So let's say they're making $100, they give back $50 as a dividend. That's a nice solid payout ratio. Those are the kinds of companies that we're after in our dividend strategies. And it kind of falls into that smart beta. Sometimes we use that word smart beta style of investing. Yes, you could take the broad market, but by going with, a different approach to it, in this case, dividends, can lead to potentially a better result on the risk and return basis. So, it can be a very effective building block for clients. And, especially when it's done the right way, which, I think we're doing at BMO by focusing really on those blue chip dividend payers.
Yeah, I mean, the stock quality is always number one, right? It's always the foundation. Very important to have those great companies. So thanks for that, Chris. So Andres, now let's get into the actual covered call strategy. Now, so can you provide us with a 101 in terms of how a covered call strategy actually works?
Yeah, it's sometimes can seem complicated, but it's actually quite straightforward. So you have two components to it. On one part, you have the stock portfolio. And obviously, there's a lot that goes into the composition of a long basket of stocks. And then you have the short call. So what the short call does is, by the name, it's covered calls. is, it's within the world of yield enhanced strategies, and what they're doing is once again enhancing the strategy or enhancing the yield of your portfolio. In this case, you have short calls, but you also have short puts and a variety of other strategies. If you look at the actual components, so obviously we already talked about the long basket. In the short call, what is a call? You're going to ask. I think a lot of people are going to ask themselves what a call is. And the holder of a call gives you the right, not the obligation, to buy the stock. Now, so if you're on the other side of that, if you're shorting a call, you might need to sell your stock to a buyer. And so that basically what that does is that commitment to sell a stock at a specific price and expiry comes with a yield. So in exchange for that commitment, you are getting a premium, and that premium is enhancing your portfolio of long stocks. Now, when it comes to the call option, you have a variety of options. You can do different strikes. You can have different expiries. So it can vary quite significantly, and the yield of the strategy can vary depending on the strike and the expiry. I know we'll likely get into this in more detail, but you generally have anywhere from 0 to 3 months in expiry, and also relatively close to the money strikes and whatnot. So it can vary quite significantly. But overall, what ends up happening is that you write calls on a long stock position, and if you do that systematically or over time, you're earning that premium on a portfolio, and eventually you're going to get a yield, and Chris mentioned it, let's say 3 to 5% over that long stock portfolio, and put that all together in one package, and that's cover calls for you there.
Yeah, perfect. Thanks for that great overview. So basically you're writing calls on stocks you love to keep long term, basically, right? So that's the overall. So Chris, tell us a little bit about BMO's specific strategy when it comes to covered calls.
Yeah, for sure. Like, Andres was saying, there's a lot of choices to make, right? When you build that covered call portfolio. And, the way we look at it is there's two things you want to get out of this strategy. Obviously, everyone wants income, and that's a primary driver. But you also want to have some growth from your equities as well. So it's a mixture of income and growth. The trade-off with a covered call is how do you do it so you get both, right? And that's what we want to deliver. So the way we do that is, first of all, we just cover half the portfolio with covered calls. So that allows the other half that's uncovered to fully participate from equity growth. And I know it's been a challenging 2022, but over time we expect equities to deliver growth, and they have historically, right? So that allows half the portfolio to fully participate. And then on the portion we do cover, we always sell those options out of the money. So it allows stocks to go up, a modest amount before they encounter those strikes. And again, that's another feature of what we do that allows more upside participation. So when I look at BMO overall, I characterize it as a very non-greedy approach to covered calls, in that, yes, we're going to get that high level of income, but we do it defensively. And, as we're in 2022, where obviously equities have come down, been challenged, we do expect that recovery to happen over time. Again, by having a less greedy approach, I think that will help set us up for more upside participation going forward, and really allow investors to benefit both on the income and the growth side.
Yeah, thanks for that, Chris. I completely agree. I love how you said both income and growth. Of course, you don't want to write covered calls on the whole portfolio. So BMO does it on half the portfolio. So automatically half of your portfolio fully participates in whatever the stock market does, including when it goes up. And since the calls are written out of the money, even if those calls that are written on half of the portfolio are exercised, you're still participating a little bit in that growth. So non-greedy, like you said. Perfect. Thanks for that. So Andres, let's take a look at the breakdown of the covered call ETF marketplace in Canada. Can you give us sort of an overview of how it's going in Canada when it comes to the covered call market?
Yeah, if I had to give you a broad overview, I would say right now there's about 12 issuers in the covered call space, about 100 products or so in the space, and it's actually a very substantial part of the Canadian ETF landscape. If you compare it to the U.S. landscape, it's actually very small in the U.S. It's one of those rare areas where Canada dominates in an area, and they've kind of done such a good job, and BMO has done such a good job with call it 60% market share of the space. So it's one of those unique areas that have blossomed in Canada. And why is that? It's because the Canadian investor likes yield, and covered calls is an ideal way to get that yield. So if I had to split it into two, you will look at systematic strategies, and you will look at, call it actively managed strategies. Those would be roughly the two ways I would split it. In the systematic strategy, which would include BMO ETFs and many other issuers, you have a rules-based approach to cover call writing. For the most part, these issuers would stick to the rules, and it's clearly outlined what they're doing, how much they're covering, general picture of the strikes and the maturities. And then on the other side, you have the active strategies, which tend to be a little bit more opportunistic and tend to look for scenarios where they prefer to sell calls and whatnot. So the coverage ratio might change, how many stocks they're selling calls on might change, and the strikes and whatnot. So those is, generally speaking, the two worlds that you have within cover calls here in Canada.
Perfect. Thanks for that. Much appreciated. So Chris, before we get into key considerations, in a nutshell, what would you say are the actual benefits of a covered call strategy? Andres kind of touched on it a little bit there.
Yeah, I mean, I think we're getting into it as we discuss it, but obviously it starts with a higher level of income. Like CPI this year is in that 7 to 8% range. There's not a lot of tools that can really sustainably, generate that level of yield. So covered call is one of them. It's an immediate attraction. Tends to lower the volatility of your overall portfolio versus an uncovered strategy. Because if you think of it, we have this income stream from the covered calls, and no matter what, you're getting that high level of income stream. So it tends to dampen out that volatility. There's a tax efficiency benefit that I think we might get into later, but they're very tax efficient strategies. And from the ETF perspective, like all ETFs, kind of frankly, is that one ticket exposure, and you get all those benefits of ETFs: intraday liquidity, low cost, and that ability to get build that exact portfolio exactly how customize it to your needs. So I think there's a lot of benefits, and it can add a lot of value for clients.
If I may add to that, that's okay. The way we tend to look at this is a completely separate asset class, right? Like, we shouldn't be viewed as comparable to a long-only portfolio. So a lot of the attributes that they have is they lower the volatility, like you mentioned. Like, lower vol at the end of the day is a natural impact of selling calls. When you're selling a call, without getting into too complicated of a thing, if you're selling calls, you're selling volatility. If you in your longest stock portfolio, which is long volatility, you're naturally offsetting some of the long volatility of your portfolio. So that is very important, and that's not really seen in a long-only portfolio.
Yeah, completely agree. And the way I usually talk about it is that if you have two portfolios, the exact same stocks, one of them has the covered call strategy, the other one does not. Well, the one that has the covered call strategy is a little bit more defensive. And you mentioned lower volatility, and that's because that income tends to be relatively stable over time. So like you said, Chris, it kind of cushions if there's a lot of volatility in the market, like what's going on right now. So thanks for that, guys. Andres, what are some of the challenges that these ETFs solve for investors who may be thinking about doing this strategy on their own? Because you could actually just buy the stocks yourselves and sell the calls yourself, but instead you could get it with an ETF that's a little bit more hands off. So what are the challenges that getting a covered call ETF versus doing it yourself fixes, basically, or takes care of?
Let me put it this way. So in my previous role in my history at my current firm, I used to work with some of our clients that used to do this on their own. And I can tell you from experience that this is a very labor-intensive strategy. So when you're paying a manager to do this, you're getting your money's worth in terms of the work that is being done to do this. I'll give you a quick step by step on how the strategy works, so you get an idea of how much work is involved. So obviously you have to pick the stocks, and then you have to rebalance the stocks if you want to remain within a certain weight or a certain exposure. So that just the long stock portfolio in itself is a lot of work, right? And then you have to start deciding which calls do I sell, which, what's the strikes do I sell, which expiry. And you have to look at the volatility curve to see where it makes sense. And then you have to say, okay, well, now that you actually did it, you're long a stock, short a call, then what happens if your call gets called away? Now you're forced to sell your stock, and then you have to buy the stock back again, and then you have to sell more calls. So that's a lot of work because you have to manage this on a monthly basis or on every 2 months or so. So if you add a portfolio of 10 plus securities, that becomes like a full-time job to just do it, right? So I can tell you that there is a lot that goes into this. There's a lot of analysis. And it's one of those strategies that it benefits the investor a ton to actually do this in a packaged format via an ETF issuer.
Maybe I'll add to that one if it's okay, Adrian. But just to add to it, not only is it a lot of work, but also the pricing we get. And we partner with, all TD and all the big banks, but the pricing we get, is very attractive as well. So it's another benefit, as an institutional trader, BMO can bring to the table because everyone wants income as efficiently as possible. So the pricing is, a nice benefit that, people can benefit from.
And not just the pricing, as an institutional client, you can get custom strikes, you can get over-the-counter options. So these are features that are only really done by some of the institutional clients. The average mom and pop on the street is very unlikely to be able to create a new strike on the Montreal Exchange or any exchanges in the US.
Mm-hmm.
Yeah, I think you guys hit the nail right on the head there. It's very complicated to do it on your own. And I've actually spoken to many people who have done it on their own for a long time, and they're transitioning into these covered call ETFs because it's like you said, it's like a full-time job. It's almost like day trading. So it's very, labor intensive. Might as well, have the professionals handle it. That's what I say. I love covered call strategies. I've never written a call in my life. I don't even have options enabled in my broker account. I'd rather leave that to the professionals. Just a quick question for maybe the both of you. Who's actually buying these call options? I mean, especially in a bear market, right? Sometimes investors might be thinking, well, who's actually buying these calls? Because you guys are writing them pretty much every month, right? On the stock. So how would you answer that?
I'll start maybe, and I'll just say, it's a deep market. There's a lot of buyers and sellers, especially in the US, it's a very liquid market and there's a lot of buyers and sellers. But, in Canada, I would say, and have to kind of reiterate, it's a very institutionally oriented market. It's what we call an upstairs market. So we trade, in block trades with, the major institutions. But, that being said, there's a lot of appetite. And sometimes people think about, well, how big can these strategies get? There's a lot of appetite out there. And, we actually, structured the right way, which we always try and do. It's quite a liquid exposure.
Yeah, what I'll say is that who are the buyers? Market makers. So there is a large group of professional market makers in options. And their sole job is to quote on options on a daily basis in the same way that we do on ETFs. So most of the major banks in Canada, but a lot of independent shops too, are the market makers for these options, being selling or buying. And one thing that is important to understand is that as a market maker, or in general, market makers are not in the business of taking views on the options. So they hedge themselves immediately. So in the case of an ETF issuer selling a call and a market maker buying that call, they would immediately hedge themselves via the stock underlying the call. So it would be called what we say fully hedged or delta hedged. And in that case, there's no exposure, and their role there is to facilitate trading in that option and create the liquidity for the seller.
Very interesting. So the underlying is that there is an appetite for these call options, no matter the market conditions. That's what I got out of it. So thanks, guys. Really appreciate it. Let's go through some key consideration of these strategies of covered calls. So Chris, what should investors consider when it comes to the options writing strategy on the portfolio?
No, I think let's circle back to that income and growth. What do people want to get out of this? You want to get both. So when you're looking at, there's 10 plus providers out there, you want to just be comfortable with the strategy you're getting. And furthermore, like that construction on the underlying equity. is also very important. Like, we're going to start with that underlying equity. You want to build a strong house, you got to build a strong foundation first. So looking at those two things, I think, is important. I think it's also important to look at the experience of the manager in this case as well. And, it can be a little bit depersonalized. Like, you go on the exchange and you buy a three-letter ticker, a four-letter ticker. But really, when you're buying that, you're not just buying, a ticker. You're buying, the experience of the manager to deliver you a good experience. And, we've been doing these strategies since 2011. We're leading the market in these strategies. So when you're buying one of, our products, you're not just buying a thing, you're buying our experience in running these strategies. So I think that's something as well that people can consider.
Perfect. Yeah, it makes complete sense. So, Andres, what should investors consider when it comes to the general market environment? This is more of a broad question here. So what should they consider when it comes to the general market environment or market direction when thinking about investing as a whole?
So the first thing I think it's fair to say is that cover call strategies are all season strategies. They do work in every single environment. As I was saying earlier, they should be considered completely different asset classes, right? The focus here is yield. So yield under any single environment. Now, that being said, obviously there are scenarios or environments where cover call strategies do better. And that's times with higher volatility, when you have choppy markets or sideways markets and down markets. So similar to what we are experiencing right now. And it's pretty straightforward. If you have higher volatility, without getting into too much detail, if you have higher volatility, that means that you're going to generate more premiums on the options. Why is that? Well, the main input into an option or a call option is volatility. So if you have more volatility, more premiums. If you have more premiums, you have more yield. If you have more yield, then you have either more upside or growth, as we were talking about earlier, or more yield on your strategy. So generally speaking, higher volatility, choppy markets, down markets are when these strategies tend to do quite well relative to a different group of strategies. But overall, if your goal is to exchange growth for yield, which is what you're doing when you're selling a call over a stock, then these strategies work very well under any scenario and should get you to your goal, which is a certain amount of yield.
Yeah, I agree. It's important that every investor has their own goal. And like you said, I keep saying all the time that cover call strategies are defensive. And now, you basically were talking about why that is. When there's higher volatility, that's when usually, investors tend to be a little bit more scared. So these are more defensive products, which give you more stable income. So this is why, nowadays I'm very happy to be an income-oriented investor where the bread and butter of my strategy is really covered calls. So very, very interesting. So something that's been dominating the headlines is, of course, rising rates, right? Rising interest rates. So how can, higher interest rates affect or impact a covered call strategy?
So it's like Andre said, volatility is the most important input to the price of an option. And more volatility, and we've had more volatility, can lead to more yield and more kind of attractive outcomes. But another input is the interest rate. And we're looking in Canada, interest rates have gone up about 300 basis points or 3% this year. When you plug that into the formula, you actually get another % of income on the options. So again, this isn't the primary driver of an option price, but it is nice that with the covered call strategy, even in this choppy environment, but with higher interest rates, you can generate a little more income. So, again, if that target is between 3 to 5% that we have, helps us get, to our targets and maybe towards the upper end of those targets. So overall, it's a good factor, and I'll just go back to it again. Helps keep pace with inflation from a yield perspective.
Okay, good. So it's actually a good thing. It actually does help a covered call strategy. That's good because and this is maybe an extra question for you guys. How would you respond to investors who really want that safety but are invested in more fixed income and bonds? What would you say the advantage that a covered call ETFs have over the more traditional fixed income type of securities?
I'll just start by saying, we think both have value and a place in portfolios. Fixed income is getting a little more interesting now. Like we're seeing yields on the short end and that 4 or 5% level, sometimes north of 5%. Is very nice, but the thing we also have to remember is inflation's still 7%. So to deal with inflation, and also, fixed income pays you a coupon. Fixed income doesn't pay you capital growth. So, an investor who wants both income and growth and wants to keep up with inflation and hopefully surpass inflation, you got to have that equity element in there. And the covered call can give you that equity element, but again, with that higher level of yield. So, I think it's not one versus the other, but you want both.
Yeah, very interesting. I will also add to that, and Chris, you kind of touched on it earlier. You said very tax efficient. Covered call strategies are tax efficient because the premiums, they're not taxed as interest or dividends, they're taxed as capital gains, which is taxed much better than interest in Canada, right? So I would say that's also another advantage these strategies have over traditional fixed income. So thanks, guys. Really appreciate that. Now let's talk about fees. Of course, I'm sure you guys get a lot of questions about fees. So Andres, fees are, they're obviously it's a very obvious consideration. So what are the best practices when it comes to evaluating the fees on these types of ETFs, covered call ETFs?
No, and that's a very good question. It's very important that you look at total cost of ownership, not just the management fee. Most advisors, most clients look at fee and they just go to a web page and they'll see management fee and they'll say, okay, that's the cost. But in reality, that's one part of the cost of ownership. You should look at obviously at total cost, which is MER, and also the TER, so the management expense ratio and the trading expense ratio. If you add those up, you're going to get the total cost of ownership for an ETF. Now, where do you get this information? Regulatory documents now mandate that a lot of the issuers publish this on their websites, so you can go and find the fun facts in many of the websites of the issuers, and it should say there what the MER and TER is for these specific ETFs. And just to step back for a second and explain them, so the management fee is basically the investor paying for the fund manager to implement the strategy. But then in order to implement that strategy, you have operating expenses. And those operating expenses add up to the MER of the fund. But you also have trading expenses. And those trading expenses are not really shown in the MER. So those are shown in the TER, the trading expense ratio. So those are very important because although generally speaking, they're fairly small, they do add up and give you the total cost of ownership. So what I would say is important to do your homework, understand the MERs and the TERs of different ETFs, not just the management fee, and then use those as part of your decision-making process to selecting an ETF.
Yeah, and what I would add to that is that all the management fees, the MERs, is all disclosed on the fund's official website online. I always tell people, go on the official fund's website, ETF website, look at the fact sheet, and all the information is there. And another thing I would say also is that some, especially newer investors, get kind of confused of how actual management fees work. The way I like to explain it is they're kind of included in the fund, which means that their distributions or the dividends are all net of management fees as well. Do I have that correct?
That's correct.
Okay.
And by the way, the website is a brand new website as of this fall. So please visit the BMO ETF website. I'll put a plug in there.
Good to know. Good to know. Excellent. Excellent. So Chris, speaking of BMO's website and BMO's ETFs, you guys have a big selection when it comes to covered call ETFs. Like we discussed earlier, BMO has about 60% of all the covered call stuff in Canada. So can you give us an overview of a few of your covered call solutions?
Yeah, for sure. Thanks. I mean, we started talking about the dividend once, starting from a dividend base and then implementing the covered call. So that's our high dividend covered call suite. ZWC, ZWH, ZWE, that's Canada, US, Europe. We've got a global ZWG. So again, if you're looking for that equity income exposure diversified across sectors, high dividend covered call suite. And then we have more sector strategies with a covered call. And our first covered call that we launched was ZWB on the Canadian banks. And Canadian banks, again, are great dividend growth machines over time. But ZWB writes calls upon those Canadian banks to yielding close to 7%. We also have US banks, utilities, which has fared a little bit more well as well in this challenging market, and even technology, which is a great example, and just in terms of how we can take a non-income producing asset like technology companies, but bring that yield up, into that 5-6% range in that case. So so we've got core strategies and we got sector strategies, and they can be found on our roadmap, and and we talk about them, on our market insights as well.
And I think that's an important point you made, because many investors will have non-yielding parts of their portfolio. And in times where yield is important, cover call strategies allow for that creation of yield in an area where previously there was none.
Yeah, perfect. So I like the BMO lineup. I like how you guys have two separate kind of, like you mentioned, you have your regional, I call them the regional dividend ones, where you could get, ZWC, you get the Canada, the US, Europe, global, and then you have your sector specific ones if you like a particular sector, you believe in a particular sector, like tech, which is very, very hard to get yield because technology stocks usually don't have dividends, right? So it's a good way to get some yield off technology stocks. So I thought that's very, very interesting. So what about investors? This is for Chris again here. What about investors looking for an all-in-one diversified cash flow solution? What is a simple way investors could get started with an income approach to investing? Let's say if they're a bit newer to income investing.
Well, there's a couple different ways to look at it. The one we just talked about, the ZWG, it's global equities with a cover call overlay. So from an all equity perspective, there's that solution, which is, it's all cover calls and has all the benefits that we're talking about, and certainly a healthy yield. Also within the kind of what I call the balance space, when we think of a 60-40 balance portfolio, we've got the ZMI, which is the BMO monthly income ETF. It combines our dividend ETFs along with that ZWG global cover call, and then also has an element of fixed income, mostly corporate bonds, because they offer a little more yield than governments. So that's another kind of all-in-one solution that can take advantage of these strategies.
Yeah, perfect. And one thing I really like about these types of solutions, and for all the ETFs you mentioned, they have monthly payouts, which is really, really cool, because if you would just buy, the individual stocks on their own, or if you're doing it on your own, you typically get a quarterly payout. So getting a monthly payout is really nice in my opinion, especially if you're an income-oriented investor, you're a retiree, and you want that monthly income. It's much better than, waiting every 3 months, I would say. So another cool little advantage with, these types of products. So guys, thanks so much for discussing these income-oriented solutions. It covers, we're finished our discussion. So thanks so much to Andres and Chris for bringing such great insights around covered call ETFs, as well as the considerations, right, that you need to look at if you're trying to adopt or implement this enhanced income approach to your portfolio. So once again, thanks to BMO ETFs to continue to host these educational segments for do-it-yourself investors. And hopefully we speak again soon. Have a great day, everyone. Take care.